Hey there, everyone. It's Oliver. So today I've thrown on this suit and I've decided that I'm going to be chatting about some monetary policy stuff in Canada. I want to try and understand the real estate market in Canada as well as understand what's happening with inflation because everybody's been talking about it. So, yeah, that's what we're going to do today. So, as of today, here are some of the most important updates. It's June 9th, 2021. Basically, they're not increasing the interest rate, it's steady at 0.25%. They also have a quantitative easing program, which continues at $3 billion per week, which is things like the CRB, etc. And here they talk a little bit about asset prices increasing and commodity prices, mainly oil, increasing, and the Canadian dollar also seeing some appreciation, which is very nice. So, despite the second wave of the virus, the first quarter GDP growth came in at 5.6%, which is lower than the bank had projected, but it's still very good. Employment rate remains below its pre pandemic level, with low wage workers, youth, and women continuing to bear the brunt of job losses. They said that they're going to keep the interest rate pretty low until the 2% inflation target is substantially achieved. And this projection for when this will happen is in the second half of 2020. So at that time, they're probably going to start increasing interest rates to, try to balance out the economy again. If we go back to their April monetary policy report, so lots of vaccination rates, which is really good. Right, so you have bond yields that are kind of returning back to normal, which is good to see. And then here we have the Canadian dollar versus the US dollar. Around here, it was getting close to 68 cents, and now it's trading at around 80 cents. And even like now, it's closer to this 84 mark, which is very, very good for Canada. Maybe not so good for the United States. And I think part of the reason is that Canada is keeping its so called inflation under better control than the United States because I think in the US, inflation's year over year is sitting at around 5%. Meanwhile, here it's sitting at around 3%. So that could be part of the reason why the Canadian dollar is strengthening. But the bank projects US GDP to grow by 7% in all of 2021, which is good. The fiscal package announced by the United States in December boosted incomes and consumption. But I think the biggest thing to look out for is in the middle of 2022, when interest rates go up, you will probably see a decrease in housing values, decrease in asset values because borrowing is more expensive. So at that time, it might be prudent to kind of reevaluate where your investments are. So the Bank of Canada in April adjusted their forecasts from the January report, and back in January they projected that they would that the economic growth would be a lot lower than it is now. January GDP growth is revised up by 2.5 percentage points to about 6.5%. As a result, the real level of GDP is 2.5% higher in 2021. Blah, blah. Basically, they adjusted it upwards a lot because there has been stronger foreign demand, higher commodity prices, improved business confidence, improved terms of trade, higher output, additional stimulus combined with this is an important one, earlier recovery of consumer confidence, which means that people are feeling a little bit more confident. But then you'll have the other side of things where you got hit by the third wave and people are not feeling quite as confident because of that. And now these high contact service sectors have recovered a little bit, but they're probably getting hampered right now even more by the third wave in much of the country. But luckily, vaccination rates are going up, so you'll probably see something like this happening, and hopefully it'll get back up to previous point sometime in 2022. Now we get into something else that I've been following pretty closely, which is the Canadian housing market. House prices have risen more rapidly outside of city centers. So here we have distance from city centers 0, 10, 20, 30, 40, 50, 60, 70. And these are the major 6 city centers. And you see as we go this way on the lines, that the further out that you go from the city center, the greater your appreciation in home price values, which I think part of the reason is that money is flowing from the city centers into rural areas and suburban areas. I think they mentioned that here. Remote work, national resales are at record highs, inventories are at record lows, prices have increased rapidly. So, because there is much less supply than there is demand, and a lot of people are less willing to list their homes for sale. That all of those things have caused the prices to have caused housing prices to increase. Right. So the pace of construction over the past year has been hampered by containment measures, shortage of materials, and skilled workers. So this is also putting upward pressure on construction costs. So new homes are more expensive, resale homes are more expensive, everything is more expensive. And there's much more demand than there is supply because people are holding back from selling because they're worried about the virus, obviously. So, what starts out as fundamental based behavior can turn into more speculative, exploitative behavior. This possesses several risks. So, the high prices can result in stretched borrowing and lending, which means that eventually, when things return to normal, so you'll see that house prices, residential investment, and consumption could all decline if people are really strained on their incomes. And if we see interest rates go up, people will have to put more money towards their houses, which means that they won't be able to put money towards consumption, which could hamper economic growth in the future. Another important thing here was that the reason that house prices have gone up and that people are able to spend as much is because job losses have risen during the pandemic, but they've been concentrated among low wage earners who tend to rent rather than buy, which means that people spent more time at home and they wanted larger single family homes in rural and suburban areas, which essentially means that the people who were renting kind of got fucked in this whole thing, and the people who had the good jobs already can work from home, and now they have a surplus of income that they don't know what to do with, which drives housing prices even higher, alongside a lack of supply and a lot more demand for these kinds of houses just cause the prices to go boom, 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 you know? But there's also a shortage of workers in pretty much every field. And I've actually been hearing that a lot of businesses in the hospitality, like restaurants, are starting to prepare for reopening, but they're having trouble finding workers. Even McDonald's, from what I've heard, is offering people like $50 gift cards if they just apply to the company. So I don't know, maybe I'll go and apply to McDonald's and get a free $50 gift card. So I've even been hearing this from people who are paying their workers like $22 to $28 an hour, but they are still having trouble finding people because the people would rather take their basically take their government handouts than go back to work working at a job that pays between like $20 to $25 an hour, which is a lot more money than they would be making sitting at home. It's the difference of about like give or take $500 a week. They could be making more, but because there isn't really anything they have to spend, there isn't like any real reason for them to go back to work. It's very, you're seeing a shortage of people who are willing to work. But as I think I read somewhere that in July, the government supports are supposed to decrease to $300 a week from $500 a week. So that might help entice people to return back to work. But this is a very big problem, especially for businesses that are looking for workers. But I also think this could have the effect of driving wages up for low wage workers, which, in my personal opinion, would be very good. And that would help people across the board and hopefully get rid of some forms of inequality here, and people might actually get paid living wages now, which I think could be a positive side effect. But of course, that's yet to be seen, and who knows if that will actually hold out beyond a few months past the pandemic. But presumably, if you get a job and it's paying say $20 an hour as a company's minimum wage rather than 15, I don't think that they will be able to negotiate you down to $15 an hour. But that's just speculation. So hopefully this kind of crunch for workers could actually help some people in the long run and provide living wages to more citizens, which would be great. I think this also kind of helps explain the the rise in housing prices, even the rise in inflation. People are willing to spend their money. Back in April, the savings rate was at close to 30%, and even after that, it was close to like what is this, 15%, and it's supposed to equal out to about 4%, but prior to this, look at that, it was like around 2-3%, and yeah, man, it's wow, and they're projecting that it's going to take a while to get back down there. So But there's also kind of speculation that this number that people are willing to spend a little bit more. So maybe we won't see this kind of delay that they're expecting. Okay, now let's get into the Canadian Real Estate Association national statistics. So May 17th, between March and April, these are kind of the home sales and what's going on in the market. As you know, it's pretty wild. National home sales declined by 12.5%. Not a huge deal because compared to last year, activity was up 256% in the month, which this was essentially March and April were essentially the height of the pandemic. So nobody was doing anything at that time. So naturally, this number would be kind of really high. But this part is a part that just kind of like blows my mind. The home price index rose 2.4% month over month and was up 23.1% from last year. National adjusted sale price posted a 41.9% year over year gain in April, which is absolutely nuts. 40% return on investment if you bought a house last year. Why didn't I buy a house at the peak of the pandemic, man? Like why didn't anyone tell me this? I'd be worth so much more money. Holy crap. So this chart is like this is the crap that blows your mind, right? Like January 2020, less than $600,000. January 2021, we're reaching $750,000 as the average home price, which is absolutely ridiculous. And that number is like going to keep going up. Obviously, I personally think that it's going to get overextended and there will be a correction in the downward direction, probably sometime mid 2022. So save up your money, folks. Better buy quickly in 2022 because the trend is just going to keep going up, let me tell you. At least that's my speculation. Nobody can really predict the future, but not financial advice, also, by the way. Right. And the other important thing here is that there's a stress test which started June 1st. Okay, so they increased the qualifying interest rate on a mortgage. But yeah, essentially, you will be able to qualify for a lot less money now. Oh, here we go. Here's some good math. A family with an annual income of $100,000 with a 20% down payment, 5-year fixed mortgage at 1.78% over 30 years would qualify for a home valued at $651,000 under the previous 4.9%. Now, under the 5.25%, they would only qualify for a $618,000 home rather than $651,000 from before. But the rates are still very low. As we see, there's still lots more demand than there is supply. So this probably won't change very much. If anything, it'll just slow down growth for 1 month and we'll be right back to where we were before. Yeah, it doesn't seem like housing prices will change much even after interest rates go up. But if we do see them go up, the new qualifying rate goes up to like 6.25%, as they were saying over here. That would reduce your buying power between 12 and 13%, which would mean that usually each 1% increase in rates, you see a 10% decline in housing prices, although that doesn't always hold, especially when you have savvy Canadians, because they just kind of move around. They find co-borrowers, get help from their parents, move to places that are less expensive, smaller houses, etc. So, people will adjust, and there's probably not going to be too much to look at. So, which kind of makes me feel comfortable buying a house in the Canadian housing market. But at the same time, I'm definitely not buying anything right now. So here's some more interesting news. As of Wednesday, the federal government announced that fully vaccinated Canadian travelers, so Wednesday being June 8th, fully vaccinated travelers will no longer require COVID-19 hotel quarantine upon arrival to Canada. And it used to be 3 days where you would have to stay in a hotel, but now if you want to go and travel and you're fully vaccinated, you can come back and no problemo, no quarantine for you. All right, with that being said, thank you so much for watching this video. Hopefully you enjoyed it. If you did, smash the like button, subscribe, leave a comment letting me know what you thought, and I'll see you guys next time. Hopefully you enjoyed the little economic reporting that I did, and yeah, see ya.